Candlesticks are the foundation of trading. If you can't read them, you can't trade. In this video, I'll break down exactly what candlesticks are, how they form, the most powerful candlestick patterns, and why wicks tell you the truth about the markets. Let's get straight to the charts. Candlestick anatomy. On the left side, we have a bullish candlestick. It's represented by this black rectangular pattern. On my charts in particular, I use black. Do not have too much of a relationship with the colors of these particular candlesticks because you can change them to whatever color you want them to be. But on my chart, black candles are bullish and blue candles are bearish. Let's talk about how they work. So when you're dealing with a bullish candle, it's going to have an open, create a low, make a high, and then it's going to close. This is for a period of time in price action. So one candle represents a period of time. If you look up here, 1 minute, 2 minute, 3 minute, 5 minute, 10, 15, all the way up to 4 hour and monthly. One candlestick represents a time in which it's telling us that during this 4 hour period of time, based off this chart, this candlestick had more buyers in the market than sellers. That's why this candlestick is black. So buyers were stronger than sellers in this market. Price started here before this candlestick. It went lower than the open price. It pushed to a high, then it cooled off and closed here. There's an open, low, high, close pattern when we're dealing with the anatomy of how a candlestick is created, a bullish candlestick in particular. So bearish candlesticks tell us that there were more sellers in the market at this particular period of time, depending on the time frame, whether it's a 5 minute, 4 hour, 1 hour, or daily. So this candlestick opens, creates a high, and then makes a low, and then closes. So it's an open, high, low, close pattern. Pretty simple. So one important thing you must know about candlestick creation is that we only looking at closed candles. So bullish candlestick creation. So this candle here is closed. Let's just say it's been a 4 hour time period. So there's been 4 hours. This candle has open, low, high, and close. Meaning this candlestick has printed on the charts and it's complete. It's on to the next candlestick. So if the next candlestick will be bullish, what we will see is that we will see a open here, and then the market will start to go bearish because it wants to create that low. Remember, open, low, high, close. On your charts during this 4 hour period or whatever time frame you're on, this will start to look like a bearish candle. Okay, so you will see a bearish candle. The next thing that will happen is that this market will start to come and push off. Then you will see a reversal, and now the candlestick will start to turn black because black represents bullish. And then it will push up and shoot like this, and then the market will typically come down here after it makes its high. Let's say it closes here at the end of that 4 hour window. So now we have a open, low, high, close. What you must understand is that when candlesticks are forming, they are going back and forth from a bearish candle to a bullish candle to a bearish candle until they finally create separation, make a high, then close, or create separation and make a strong bullish push for that candle. One key rule in trading is that you want to trade off a closed candle. When the candlestick closes and prints and we're moving on to the next one, that lets us know that this candlestick is complete and now I can use it for proper analysis. While the candlestick is moving, you can't really use it for proper analysis because it is still moving and being created. Manipulation will occur. So understanding this, you understand that bullish candles open and close at the top. So the next candle has to open where the previous candles closed at, and then we get an open, low, high, and close. And the next candle will open where? At the top, because this was a bullish candle that closed here. So now we're looking at bearish candlestick. This candlestick represents an open, high, low, and close. This is a bearish candle. This candle tells us that there were more sellers in the market for a particular time period. Whatever time period you have clicked up here, if you see a bearish candle is closed and printed, there are more bearish orders. Like bullish candles, that the next candle must open at the top. With bearish candles, the next candle must open at the bottom. So what we will see next is next candle opens here. It starts to go bullish. Market starts to go bullish. So as the market starts to go bullish, we'll see pushing up to make a high. Then the market comes down, open. Now it looks like it's created a high. Now it begins to go bearish. Now, as soon as the market gets below the open, now the candlesticks becomes bearish again and price pushes down. And then we can see that price either closes with a strong, extremely strong like this, or it wants to make a low. And then let's say it's a 4 hour chart with 5 minutes left. In the last 5 minutes, it moves up, closes there. Now you got that open, high, low, close pattern. This is how candlesticks are created regardless of time frame. And when this candlestick closes and prints, we have another candle. Now the next candle, let's say if it ended up being bullish, we will see something like this. Open, it's starting to go bearish first, and then it went bearish. The next thing you know, price begins to wick up, and then the next thing you know, the market ends up becoming bullish. So now we have a bullish candlestick created, and this bullish candle opened at the close of the bearish candle and ended up closing at the top. Remember, bullish candles open and then close above, bearish candles open and then close beneath. So when you see these thin lines on a candlestick, these are what we call wicks. And wicks are key because it shows us how far price actually went during that time period. And it also gives us a sign of a potential reversal or a rejection. If you see a strong wick at a key level, that is a rejection. Let's look at it on the charts to get some more detail. So now we're on the 4-hour time frame again. You see the 4H here. Let's just look at this, read this particular price action. We got a bearish candlestick, open at the high, open, high, low, close, right? Now we got an open, high, low, close. Again, open, high, low, close. Again, open, high, low, close. Again, open, low, high, close. Again, open, low, high, close. Again, open, low, high, close. Open, low, high, close. Okay, so notice that these candlesticks are printed on the charts, meaning they are here forever. They are finite. They will never be changed because these are how the candlesticks formed and created and printed, meaning after that 4-hour window, they print it on the chart. So on our chart, same thing. We see open, highs, lows, close. It doesn't matter the time frame. That's the way candlesticks are formed and created. 5-minute chart, same thing as well. So now you can see that all time frames are, of course, creating candlesticks. This is what we call a engulfing pattern. So engulfing pattern is when you have a bearish candlestick and then it is completely overtaken by the next candle, and that candle is a bullish candlestick and it prints and closes strongly above it. So if we know what a bearish candlestick, we got to open, high, low, and close. The next candle opens and closes strongly above the high and above the open of the bearish candle. This is what you call an engulfing pattern. Engulfing patterns indicate that the market wants to go higher soon, very soon, potentially right now. Okay. On the flip side, we have a bearish engulfing. These candlestick patterns represent the complete opposite. When you see a bullish candlestick, you have an open, low, high, and close. The next candlestick opens here. Now this bearish candlestick closes strongly beneath the low, beneath this open. This lets us know that price has overtaken. It's letting us know, hey, these sellers have overtaken the buyers. There are more sell orders in the market now, and this could tell us there's a strong urgency to go down now. Same thing with bullish. Let's look at some chart examples. Now, I'm not telling you as soon as you see the candlestick pattern to take that trade, but I just want to show you examples of them in the charts. So notice here, we have a bearish engulfing. What happened after that? The price has dropped significantly, 145 pips. Now we have a bullish engulfing. What happened? Well, within about maybe 20 minutes, 25 minutes, 35 minutes, price significantly had a strong bullish push, right? Over 200 to 300, 400 pips. That's a very strong push. And then you can also include these type of patterns. These are actually bullish engulfings as well. So you will see here's an engulfing. So let me give you a few more examples of these engulfing patterns. So you can see bearish engulfing, black candle, which is the bullish candle, bearish candle, strong close after. Another one here, another bearish engulfing pattern here as well. Bearish engulfings, boom, 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 boom. Now you see these candlestick patterns and you notice what's happening after. We see 35 pip move, which is a good move, 100 pip move from here, 80 pip move, and let's try this last one, about 50 pip move. So these is bearish engulfing patterns, right? And then you got these here, about 120 pip moves. These patterns, I'm not saying come to the chart and just enter when you see a bearish engulfing for a sale or buy when you see a bullish engulfing. Just telling you these are strong patterns and they have to be taken with context of another piece of analysis. Here are some bearish engulfings that I really don't consider bearish engulfings, but are technically for me. Like this is a bearish engulfing for sure, but to enter off of a strong wick, I don't like the wick because the wick tells me that this market was being bought up. Okay, so that's also a bearish engulfing as well. Notice this bearish engulfing with the wick on it. Okay, notice this bullish engulfing with a strong wick on it. Another one, this will be the last one, bullish engulfing, bullish engulfing. There's no rule at how big the next candle should be. It just has to engulf it. Okay, and that's the bullish engulfing and bearish engulfing pattern. Just understand them when you see them in context. They are not to be taken just raw on the chart. When you see this candlestick, this is letting me know price wants to go bearish. When you see this hammer, this is letting me know price wants to go bullish. These are one candlestick reversal patterns. So what's the psychology of this? The psychology is that if we have a bearish candle with a open and we're expecting it to go high, make a low in the close, if we have a strong wick, that means that price actually did go way down here. And if it went way down here, that's a strong bearish candle. But by the time it closed, it's such a strong wick. That means that this was rejected. That bearish candlestick that was so strong was rejected, meaning that something is pushing that price strongly to reject it from becoming that strong candle that it appeared to be at one point, meaning that buyers were stronger than sellers in this one particular candlestick. Okay, so this lets me know, hey, price potentially wants to go bullish now because it's rejecting. It's rejecting that strong bearish candle. Now, same thing for the opposite way. If you see a strong wick, this is a wick. Wicks is letting us know that we have a strong rejection from some level. Is telling us, no, we do not want buyers up here. So it's a rejection, rejecting it, telling it to go down. Or look at this wick as an exhaustion. Price is tired of going bullish. It's tired of going bullish, and the sellers have now pushed the market down. But something in this area, whether that's some type of zone or liquidity or a key level, is pushing that, causing that to go down. There's a strong collection of sellers here waiting to push the market down, and they push the market down. So we would say, hey, this with context is actually a key area or key market pattern, candlestick pattern, to say the market now wants to start to create those bearish. Now we see we have this pin bar. So that's a strong enough rejection for me. This is a strong rejection to me. This is a strong rejection to me. And remember, these has to be done in context with top-down analysis, so we can't just think they're going to automatically. This is a strong rejection for me as well. These are when you see that, those are very powerful in the market. Does this mean take every single one you see or believe is one? No, there has to be context in the market. Look at this very strong rejection, and what happens? Market turns around in a quick, fast, and in a hurry. Look at this here, strong rejection to where you can barely even see that this is a candle. Just continue to look at these, you will begin to see a pattern of how strong they are. This is a nice rejection, this is a nice rejection, but look how strong the rejection is compared to the candle. You see that is a nice rejection for me, or what you would call a pin bar. Look at this, huge. When you see that, huge, small body, big wick, you would count this as well. Remember, they won't all be perfect, and maybe I'll find a couple more just for people if you want to look at some super clean. As we get ready to segue into our next video, look at these wicks, right? So we understand that candlesticks do form wicks. Now I want you to understand it's very powerful, and wicks actually create liquidity. So if you're able to locate a wick, you understand the price will reverse from these wicks. Notice that we have a wick from the 15-minute here. So notice how on this chart, if you just locate the wicks, you understand that these wicks are actually, we got a wick here, look what happens. Price hits this level, wicks the wicks, which is the liquidity area, becomes a key area, and reverses. Wicks here, reverses. We can do this all day. And I just wanted to tap on this real quick because a lot of people have trouble finding liquidity, and just by this being a free course I'm putting on YouTube, I want you to understand that here you go, wicks, 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 price is reversing from the wicks over and over. It's very continuous, right? If you look here, you find this was a wick, right? Let's go a little lower because that's the truth, more true, accurate. Then we got this wick here. See how price reverses, boom, boom, boom. Then you see that even these wicks here, notice it's the rejecting off of the liquidity level, and now you're starting to see more price action take place. Now you're starting to get a hang of what's going on. Wicks, price reverses at the wicks. Why is price reversing at this wick? So we will talk about this in the next video. We also have a video. I have a video I'll be putting out just to show you how to navigate trading views. Some people don't know what to use as far as trend lines, how am I drawing this stuff on my charts. That is this trading view platform, and I'll go over that in the next video, and we'll follow that by a liquidity video. Okay, hope you enjoyed this video. Like, comment, share, and subscribe.